Well, good afternoon, everybody, from quite a grey and rainy Chicago this morning, or just about into the afternoon. I'm Moffett-Kouadio. I'm delighted to welcome you all here this afternoon. I'm the Director for Exports for the UK Government's Department for International Trade, and we're really pleased to be able to co-host this event with Spin Analytics, and to encourage you to engage with the conversation as we look at digitizing credit risk modelling and lessons that we've learned, amongst many, I'm sure, from the COVID-19 pandemic. I'd also like to formally congratulate Spin Analytics on their completed participation in this year's cohort of the FinTech Innovation Lab New York's programme. So many congratulations to you, because I think it's been a fantastic experience for us and for everyone involved, but particularly for yourselves. A little bit about us. So the Department for International Trade is primarily tasked with helping UK companies to export and invest in new markets. Almost a quarter of all UK exports come to the US, so a major market for us. We're specialised also in looking at negotiations around free trade agreements. So the US, again, a very important target for us, supporting business, as I said, but also delivering soft power and diplomacy through all of our work. We have specialists across the whole network. So I have a team here of about 160 people, and a chunk of those are working on technology and financial and professional services. And so we help companies of all sizes to seek fintech opportunities, particularly banks looking for new fintech products and services. And we help, through our team, get UK innovation into the market. So last April, our team in New York launched an insights report with Lendit FinTech on landing a successful bank fintech partnership in the US. Bank innovators seeking high quality, scalable UK fintechs should contact my team here at DIT in North America for support and further information on all of the details of that report. Banks and corporations can also register their interest in finding solution providers via our Leading Edge Global Partnerships programme, which provide UK fintechs with a platform to connect with and advance commercial dialogue with financial institutions like yours. The sector, so our fintech companies are well positioned to assist North American banks. The UK is home to one of the world's leading financial services centres, which I don't need to tell you probably, but London being my home, but also the financial services spread across the whole of the UK in other cities, is also developing fintech as one of our fastest growing sectors. Last year in 2020, we attracted 4.1 billion in venture capital into the sector, which ranks second globally behind the US. So no surprise that the US is in the lead there, but pretty demonstrative of the fact the UK punches way above its weight. The US represents the UK's largest net financial services export market, and we're keen to keep on growing that relationship. 3 UK companies were selected from more than 200 applicants across the globe to participate in this year's FinTech Innovation Lab cohort. That was Delio, Util, and of course, our partners today, Spin Analytics. So congratulations to you all again. Thank you very much to Spin Analytics for co-hosting this event. And special thanks to Panos Skliamis, CEO, and Andrew Stott, Senior Advisor at Spin Analytics, who will now introduce the panelists. And I wish you all a really successful event. But as I said, do put your questions into the chat so that we can make it as interactive as possible. Andrew, over to you.
Thanks, Francis. Hi, everyone. Great to be with you for this roundtable. And first of all, thanks to Francis and the DIT for making this possible. It's a real pleasure to be here. And thank you to the panelists, because I think we've got a great mix of views and experience and very world-class knowledge and expertise. So it'd be interesting to see how the discussion flows. So first of all, before we go on to the panel members, and I'll introduce them individually in turn, what I'd like to do is just to say that we've had a couple of roundtables in Europe and Asia on the same topic, and it's been interesting that the discussions there suggested various key things. So first of all, I think we all know that the COVID-19 pandemic was a real jolt. It was kind of outside the usual economic cycles, and presented potentially a discontinuity into the credit markets. But I think that was largely overcome by a couple of different things. So first of all, the fact that expert judgment was applied by the participating financial institutions. And secondly, because there were a lot of government bailouts. So the companies and individuals that maybe would have gone bust didn't. So 12 months on or 15 months on, we're approaching the point where maybe we'll see the default rates and the banks' losses increasing. Although I think the consensus is that banks have largely over-provided for these. The second thing is that it became clear as part of the COVID-19 spell that banks were not able to suddenly redo their credit risk models. They could try and tweak them, but even that was because of the way that credit models and data are organized and developed. That requires a lot more time in terms of elapsed time than really was available or might have been available had it not been for the government support. So this created, I think universally amongst the panelists in the other roundtables, there was a recognition that, yes, that we really have to start overhauling credit risk modeling and reduce it from these times of 9 to 12 months to build a model to a much a much shorter time. And really, it's kind of ripe for an industrial revolution in credit risk modeling. The third thing was that in parallel, the technology is evolving, and we'll hear from Charles and Sandip on this, and then some fascinating potential opportunities which we'll hear about in terms of really transforming the development cycles for credit risk models. And then finally, I think the issue of the regulators require explainable models, explainable even if it's artificial intelligence, it has to be explainable. So that's something of a constraint, something of a boundary for banks, because whatever AI, machine learning techniques are applied or can be applied, this will have to be within the bounds, at least for the regulated banks, the bounds of the regulatory framework. Obviously, we heard from some neobanks and other fintechs that actually, because they're not subject to regulation, they had developed new sources of data and were rapidly developing these models and perhaps to a greater level of accuracy than the banks. So so that was really I suppose nothing dramatically new there or dramatically surprising. So is to the panel members and get their view on the need and the opportunity for completely overhauling credit risk modeling and what is going on and what could happen. And first of all, I'm delighted to welcome Sue Harnett. Sue is independent director at OFG Holding Company Bank Board, as well as at Live Storage, has held senior roles through her financial services career at first Niagara, QBE Group, and ABN Amro. So Sue, I'm delighted to welcome you. And I guess my first question to you, having had it in small banks, my question would be, how can large banks become more nimble in the way they manage risk following COVID?
Let me start off by focusing on what the aspects of the whole credit cycle were that were impacted by COVID. Basically, all financial institutions were forced into a situation of extreme uncertainty. So their traditional data sources just went out the window overnight, and they didn't understand the changes in credit worthiness. There was virtually no data on what was going on in the crisis situation. They were tasked with being socially responsible in terms of credit collections and also re-underwriting or restructuring debt for other types of institutions. And the impact of the crisis was vastly different depending on the sector or type of employment you had. I mean, look at the difference between restaurants in the US and things like home fitness, which thrived, and public storage. I'll use that. You know, you all of a sudden had people focused on their homes and they wanted less stuff in their homes. All of this points to the need to have more nimble data. You know, in the opening comments about, you know, a credit model takes 9 to 12 months to perfect. That went out the window with COVID, and looking, we will see times of continued uncertainty as we come out of this over the next, you know, 12 to 18 months. You know, what the immediate reaction was this is going to be like 2008. So we're going to shut down credit and we're going to go ahead and create massive reserves, which had an impact on the profitability of the financial institutions. And I'm a believer that we will see releases of credit reserves over the next several quarters from all the different financial institutions across the globe. The other aspect that was mentioned in the opening remarks is was going to react. You know, first there was PPP, then there were multiple stimulus payments, all of which created massive amounts of excess deposits, which has also created a complete change in the need for credit for both individuals and businesses. We're looking at a situation where GDP growth upwards of 6% in the US, which is unbelievable. But at the same time, a lot of people feel that the credit needs of consumers, because they're worried about the cost increases that they see right now on food and gas. So that's going to change their spending habits. That's going to change their credit habits. So all of these things just keep pointing to the fact that you need excellent data at your fingertips so you can test and learn rapidly and then read the results and then adjust accordingly. If you don't do that, you won't be competitive. And, you know, the large banks and the small banks are all being faced with the same new entrants of the fintech startups that are very, very nimble. And they don't take 12 months to create a credit model. So you need to create a sense of parity across the industry pretty quickly. Otherwise, there'll be radical changes in the financial services industry and not necessarily changes for the better. It's a complicated situation, but you need good data.
And how do you think because you've been involved with several regulated banks, so how do you think that the regulators could help, because sometimes they're seen as followers rather than leaders, but can they catalyze this by because clearly the large banks with the legacy systems and the legacy data, you know, may be struggling to follow the more nimble fintechs. So could the regulators be more flexible, or could they catalyze this in some way?
Well, I think one of the things that's going on right now is the regulators are taking a look at how they update fair lending. Okay, and fair lending was, legislation that was put in place in the US, believe it or not, in the 70s. So when that legislation was written, it was not taking into consideration the sophistication that we now have in data, and also the use of machine learning and artificial intelligence. So, I think what the regulators are looking to do is to understand, the whole black box of how credit decisions are made, to make sure that there isn't a sense or any discrimination that is taking place. And, if you think about that, there's an article today in the American Banker where several fintechs, Affirm, Lending Club, PayPal, Square, wrote to the CFPB basically saying that they are prepared to help them move forward by explaining how they make credit decisions that are not discriminatory. So they're taking a leap forward. And then the banks have to have new sets of tools that match both the startups and also will be able to address the regulatory changes that are based on creating an even, fair credit system that doesn't continue to increase the gap between the different race and ethnic groups unfairly.
So we talked a bit about data in the initial comments. So given the dependence of credit risk model on data, one of the biggest potential improvements for banks may be to share data between them, or and I know that's a topic that you've thought about. What is your view on how technology can make either data sharing or credit risk modeling much more rapid, accelerated, and accurate looking into the future? Is Charles there?
I am here.
Hi, Charles. Right. Sorry, I didn't see your picture, which is why I didn't.
No worries, Andrew. So I think I think let's break it into sort of two pieces. There's an aspect of today, and then there's an aspect of the future. All right. So I think the aspect of today is how, as a CISO of a bank, you're charged with really sort of how to protect data. And so the mindset is going to be around holding things close, right? And so the first sort of step here is the sort of idea of allowing my data up into the cloud because I got sensitive information. I want to build a model. I'm going to leverage potentially a cloud-based service in building that model. And so the first piece of it is how you think about securing that step in the evolution, which is sort of one by one, but leveraging the cloud delivered technology to allow sort of faster capabilities. And that's the struggle today with that this space will have with all of the existing CISOs. And I assume at some point in life, I must probably made Sue's life difficult when she was at Citi and running student loans, and I was the head of the consumer IS. And at some point I was trying to make her life difficult, and I apologize for it. So CISOs have got this sort of thing, and the first opportunity is how to leverage sort of current capabilities to allow the use of cloud delivered services. But I actually think the much more interesting thing is the long-term possibilities. There is an emergent class of technologies, and we won't get, and this is not the audience to get too detailed, but there's an emergent class of technologies called homomorphic encryption. All right. And what the idea behind these technologies we've always talked about encrypting data in storage and in transmission as a security geek. But the data always has to be unencrypted when you operate on it, all right? When you do, the idea behind homomorphic encryption is to allow you to actually leverage data to do things like build models, to do things like structured queries against that data, but do it in a way that the data is always encrypted, but it's still viable for the model building. I will tell you today in banking, the primary places where banks are exploring this technology is for collaboration and sharing in anti-money laundering and in fraud, all right? But the same possibility exists going forward for other use cases, all right? I know at least one bank that's looking at homomorphic encryption specifically because they want to figure out, can they take their data and monetize it in model creation, while all at the same time ensuring the data's confidentiality, the privacy is being preserved. And so there is this future ability, this future capability coming where there'll be all sorts of places where banks can start to collaborate in real time, leveraging data in a way that they never could, to create new forms of value, whether it's building better models, whether it's monetizing data in new ways. There's this coming evolution or revolution on the horizon. So that's a little bit of it, Andrew, without getting too much into the weeds about crypto. Andrew, I think you're on mute.
You're right. So it happens always, doesn't it, from time to time? So how much of this, of that interesting evolution would depend on regulators' acceptance of the technology and of, because obviously they're very keen on transparency and explainability. Mm-hmm. So how would that be constrained?
So I actually think it's going to be interesting to track what's happening in anti-money laundering as an example, because that's an area where the regulators are actively engaged in the process of looking at the technology, because it is new. And so as with everything new, you will have to bring regulators on board slowly. I think in the case of anti-money laundering, there's actually pull from the regulators for this kind of capability, because there's always been this tension between things like anti-money laundering and security and privacy. If you actually have the potential to do everything you need from an anti-money laundering perspective in a way that's both privacy preserving and avoids tipping, it's actually something the regulators are really interested in. And so I think the market for this kind of technology will be driven by spaces where the regulators are actually pulling the banks along the way. But once a regulator figures out this technology is good and sound in this use case, it then becomes a much simpler conversation to have with a different part of the regulatory structure that says, well, we're talking to the model folks now, and yes, you can be comfortable with this. And by the way, you can go talk to your AML folks because they've already gotten comfortable with it. And so, but it's always going to be important. I think, quite honestly, the bigger challenges are going to be in how you prove things like bias or lack of bias in the models. I think that'll be a more challenging thing to get the regulators comfortable with than this will be in the long run.
But ultimately, I mean, I guess the utopian situation in terms of credit accuracy, credit risk modeling accuracy, is to pool all the bank's data together. So that could be
Absolutely.
through a utility, or it could be, could the regulators act as a repository of data? Do you think would that work?
I think it most probably is done more through a utility with data staying at the banks, because if you think about the model, like in the anti-money laundering space or the fraud space, the bank, there's a utility that sits sort of in the center, but all the bank's data stays in the bank's control. And the utility just literally routes queries back and forth. And so depending on how you structure it, you could potentially do it in a way where the data lives at a utility, or the data lives at the banks and the utility just facilitates the real-time processing of it. I think you, as a utility, would want to avoid having to be the custodian of data if you can, because that's just more risk and liability for whatever runs the utility to take on unnecessarily.
Whoops, still on mute. Okay, thank you very much. That's very interesting. Actually, it's very, I guess, maybe Sandip Nayak who's our next panelist, who's Chief Strategy and AI Officer at Linear Financial Technologies, and has a long background in, actually also has been at, we seem to have ex-Citi bankers populating the panel. Previously at Citi and Capital One, and I know you, Sandip, you've been working a lot on data within banks and data pooling, sharing. How are banks already pooling data, and how do you think that your work and the work you've seen can dramatically improve this rather, what seems to be a rather arcane process of credit risk modeling? Because I'm sure you have some ideas on that.
Yeah, this is fascinating. I think for us, by the virtue of our business model, which is Linear is a platform in the small business market, helping banks, many banks and some non-banks now, in their origination journey, not only through the tech, but also through intelligence. And my primary role is to weave intelligence and insights and model into their small business origination journey. Now, this is fascinating to me because for many years, we have been serving banks, right? Many banks, and this whole concept of network effect of intelligence through models and other things, because a lot of the data are residing on our platform by the virtue of serving many banks. And what has become for us is, since Linear has a skin in the game, we have our own portfolio, right? While also helping the other banks originate and process their own products on their own balance sheet. We have effectively become a test bed of a couple of things. One is trying out many data integrations and alternate datas, right? And secondly, create models and logics, which is used by our portfolio, which in the sense becomes a testing ground for many banks to be adopted by them. So I talk to chief credit officers day in, day out of my bank partners to enhance their intelligence game while using our platform to drive better outcomes. And some of the use cases I have seen over the years is, since we are building intelligence and models for us on a national footprint of data and customers from our existing banks, that drives much superior accuracy, as well as, and which they don't have to use right away, right? We are driving it on our portfolio. But what the outcomes we have seen is this has empowered our bank clients to adopt more data sources, right? Which has been proven through either our portfolio and elsewhere, and also look at our models closely, either adopt some of that or all of that into their decisioning process, right? to enhance their outcomes, business outcomes, right? Now, along the journey, the use cases has been in the fraud, like Charles said. Since fraud being a needle in a haystack problem, banks really benefit from the network effect of all the participants on our platform, and something they're willing to share through our platform, the intelligence, obviously, while still maintaining the privacy and security of their own customer info and everything else. So I think there is a opportunity and a future where I can see that pooling of data and intelligence sources can really empower and create win-win situation for all the FIs, and to be honest, some of the non-banks who are getting into embedded finance. So that's my 2 cents on what I've seen in the last few years with working with my bank partners.
So how do you, let me just add a follow-up. So
Mm-hmm.
Clearly what I touched on at the beginning was that in COVID, I think banks realized that their models were not forward-looking enough, and they have been looking for new data sources. So for example, one of the European banks we spoke to is talking to a global telecoms company about exchanging data on what kind of smartphone customers have. So what kind of new sources do you see being used, and is this a key part of the evolution?
Yep. And good question. I think with the onset of COVID last year, various banks to some degree use less of alternate data, what we call cash flow data, and some of the advanced data sources and models, right? And while we, for our own portfolio, which is a test bed for many banks, have been using some more advanced sources and advanced mechanisms to underwrite and originate. AKA, we have used digital cash flow models, right? And a couple of more alternate data sources integrated with the traditional data sources, whether it is DNBs and consumer bureaus of the world, and even before pandemic. That's point number one. Point number two is we saw an increase in fraud, whether for the small business program, whether through PPP and for otherwise, right? And what happened with the onset of PPP, and even before that with pandemic, is it kind of expedited some form of adoption of some of the advanced cash flow models we had, because in small business, even if the models break down or become suboptimal, the cash flow part is still fundamental to their process, right? And with the onset of pandemic, a lot of our bank partners and even those who are not partners with us, I heard they have adopted some of the cash flow elements, alternate data elements of intelligence, as well as looking to enhance and shore up the fraud defenses as well as we move on from pandemic. And these are some of the things I saw firsthand with our bank partners, and that trend has accelerated since then in terms of adopting digital ways of credit risk management as well as models.
Okay, that's really interesting, and it seems data is king, and we need to the extent you can accelerate and broaden your data sources and really manage those in a artificial intelligence in a very rapid learning environment, and that is probably the way we're going to industrialize this core process. Right. So thanks, Sandip. So now I'd like to welcome Marc Intrater. Marc, who I know well, he was a colleague for many years at Oliver Wyman. He was one of the top experts in Oliver Wyman on the risk methodologies, and then spent time in Standard Chartered, where he was head of group model validation, and then also in Bank of America. So Marc, welcome to the panel. And I guess, the question for you is, given that you've seen in the market the evolution over 20 years of credit risk modeling, and you can see the I think you said the other day that the big banks have lots of work and not enough resources. So how can these pain points be addressed in practice? Obviously, we've heard of some new technologies which are evolving, but obviously the banks have a need here and now. So what are the pain points and how are they going to be practically addressed in the near future?
Yeah, and this is a little more nuts and bolts, getting away from the exciting of the new things, but it's the practical issue of, it's great to talk about wanting to adopt new types of modeling, having to adopt new types of modeling for COVID, for new regulation, wanting to use new techniques, wanting to use new data, but then there's the poor guy who actually has to get it done. And particularly as we're trying to do more and more, it makes it even harder to get it done. Typically, the groups doing risk analytics at banks were already fairly busy. We're already in a point where they had to do a lot of triage and put things on a back burner. They had, in particular, regulatory concerns. So regulators would examine models. Whatever the regulators examined had to be addressed immediately. So that gave them the first issue. And then you had new products that the bank was asking for. Then you had possibly other management priorities. And although banks would like to try to use new data, try to facilitate new products, they often have just been too overworked to be able to do that. Staffing has been a big problem. Again, even before COVID, there was a time when smart quantitative people wanted to work for a bank. Now, the types of people who can do quantitative risk modeling, particularly in the consumer space, are exactly the type of people who could be working for a fintech or working for any internet startup or working for a Google or an Amazon. And so it's very hard to get people, particularly to get good people. What possibly could alleviate some of that and can make the work more manageable is the fact that there's a good amount of the work which isn't truly new, but it's variations of things. So one of the big projects that banks have had recently is getting the CISO regulations for the new accounting regulation for how you do loan loss reserves. It goes by IFRS 9 outside of the US and CISO in the US. And you need to have models to do that. And largely they're the same models as you use for your credit risk, but they're not quite the same. And you can't just use your models. So what you have to do is to take the models you already have, but adjust them. And in theory, that ought to be not that hard. That ought to be a lot of cost savings because you've done a lot of the work. In practice, the way most banks do it, they don't have an industrial approach to model building. It's very much a bespoke, individual teams or individual modelers build the model using software tools that they often build themselves. And somebody going back to it even 6 months later, let alone 2-3 years later, usually tries to look and to redo what was done and usually concludes that it's going to be faster if I just do it myself and start over again. So there's a huge waste of effort of every project essentially gets started from scratch. There's been a lot of talk about trying to automate the process, a lot of talk about new technology in model risk building, but most of that has been focused on the sexy stuff. The sexy stuff is trying to do artificial intelligence or machine learning, and we can get the machine learning model to create a better model than what we have. In many areas of bank risk, we don't need better models. The models that the banks have are about as good as they can get given the data they have. What they need is a better process for creating models, and that's something that's been less addressed. So again, there's lots of tools and lots of talk about exciting ways of doing new modeling, but you currently have a process which is, again, very much bespoke, very custom tailored. A lot of big institutions have a non-invented here mentality, so aren't very nimble and adapt to taking on new things. And as we look about trying to get these departments to support all the things that we talked about, both the challenges of having to build new models to adopt to a new credit risk environment given COVID, and there's going to be a new credit risk environment next year as the economy restarts, and probably a new credit risk environment the year after that as the economy normalizes, but maybe in uneven ways, as well as trying to deal with the exciting challenges of how do we get new data? How do we be more nimble? How do we use new AI techniques? There's a big challenge of adapting that to a process that is very bespoke, very slow, and very regulated, and based on the idea that these things don't have to be done in a hurry. So that's where I think the challenge is. For the most part, the way it's been handled, there's been a lot of people working a lot of late hours. You don't see it because they're not working in the office, they're working at home. But a lot of these people have been fairly overworked for the last year, and it's not like they were, resting a lot in the previously.
So my takeaway from what you just said is that basically, if you are a credit risk modeler that wants an easier or more interesting life, then you shouldn't work for a big bank. You should go and work for a startup or a smaller bank that's, as Sue described, more nimble and who's more able, as Sandip and Charles have said, to advance in the technologies much more rapidly than the large banks. So does that mean that those with the biggest challenge are the very large banks? Is that the case?
I think so. And you're very much right. If I was giving advice to a young person, coming out with a degree in data science, computer science, who wanted to work on analytics, I'd have a hard time trying to come up with a reason why they should want to go work for a big bank. On the other hand, I've been a hiring manager for those big banks and have had to try to get those people, and knowing they're competing, again, not just with the other banks, which is what it used to be, and not just with the new fintechs, which used to be, but again, with Amazon and Google and all the other startup technologies who use the same skill set. And so it's a huge issue. And what they need is a way of being able to get the current staff they have, and the current staff they have are likely not to be the cream of the crop of those places, to be more effective and more productive.
So just before I move on to Panos, maybe I can just come back to Sue and Charles and Sandy, and maybe for a reaction to what Marc has just said. So do you agree that it's the large banks that have the biggest challenges? And how quickly will that technology that Charles, you described, is it easier for a smaller bank or a fintech to roll out that technology, or is it? Is it going to be feasible for the large banks to address this? Any of you have any views on this?
Let me start off, if I may, Andrew. I don't think they have any choice. Okay, you have to compete with these other players. Okay, so yeah, you might have infrastructure that's older than I am and a few other things, but it's a situation that you have to address. That's one point. The other point would be that, I would never want a regulator to define the way I have to make credit decisions. I would rather use the credit expertise that I have and recommend to the regulators that this is what we should do. And I'm a little bit nervous about some of the dialogue that I hear that, we're waiting for the government to form a credit bureau and how to define how we use AI. I think that's not what the industry should do. The industry should lead in partnership and collaboration with the regulators. The war for talent that Marc pointed out is there. It's there now, and it's getting worse. And having the ability to create, I'll call it a sexy initiative that would make the best talent in that field want to come to work for a larger financial institution is one of the challenges that they face. So it's the talent to get it done, the infrastructure to get it done. And, you know, they have the money. Yes, they do. And then, you know, one of the other things that I mentioned earlier is understanding the credit purchasing behavior changes as a result of COVID is going to be vital in how we come through this.
Right.
Right.
Yeah,
Charles or Sandip?
Yeah, I can. I
So-
agree with whatever everything Sue says. Right. I'll just reiterate one small point, is that more than the infrastructure, more than the data, and I talk to many of my bank partners, they're all waiting for a uniform signal from the regulatory bodies, whether it is CFPB, FDIC, and all of them, with respect to latest technologies. I know there is a lot of work going on behind the scenes. I mean, all these government bodies right now, right? I can tell you the talent is there. I know there is a lot of exodus from banks. Talent is there, know-how is there, and even the data is there, right? I think they're all waiting on a clear, uniform guidance, updated guidance on how to go about it, right? Whether it's fair lending and other regs. I think once that is there, that can unleash a lot of excitement within the banking community. I can tell you that. So I agree with whatever Sue said on this. Yeah.
So
Charles?
the one other thing, the one thing I would add to that is, because you sort of asked sort of like where like advantage or disadvantages, and I would actually say it's really the mid-sized banks that are sort of squeezed here. The fintechs innovate by their very nature, and the best of the large banks have dedicated functions and teams that do nothing other than test and explore innovative capabilities. Whether they adopt them quickly or not is a question that varies from culture to culture, but they've got the wherewithal and they've got active work. It's the mid-sized bank that I think is actually the one that's more challenged, because they neither have the nimbleness of the fintechs, nor do they have the access to cutting edge technology and people who think about innovation that the large banks will. And so if I go back to like a place like Citi, since a number of us were there, I mean, and you look at their D10X program, it's all about introducing 10 disruptive innovations every year. And so I think, and I think this maybe also creates opportunities, but to me, I actually think the big banks are quite well positioned to deal with the fintechs. It's the mid-tier that's in trouble.
Yeah, the other thing that I think is very important is the ability to partner with the fintech. Okay, so if I'm any size financial institution, if I can find a partner that will help me, you know, manage my data more effectively, make better credit decisions, help me understand what sources of data I can buy that isn't biased and will help me be more successful. And I think that is a good, you know, kind of middle of the road approach to innovation, is partnering with somebody that's very innovative and working effectively with them.
Thanks, Sue. You couldn't have provided a better cue for Panos, actually. So thank you all for the comments and response. So finally, on our panel, we have Panos Skliamis, who's CEO and founder of Spinalytics, which is in fact a fintech that is partnering with banks to try and address this very thorny problem. So Panos, do you want to give us a taste of some of the use cases maybe, and the types of institution that you're working with? You know, are they large banks, or are they the squeezed middle-sized banks that Charles was talking about?
Yes, hello everybody. First of all, thank you very much for the organizing by the DIT New York team, because that's very important for our team and all the expansion we are doing currently in the US market. I would like to share some of our recent experiences with large tier 1 and global banks, because our team is quite experts in credit risk modeling, and we have focus in this domain, which probably is the most difficult from what I heard from all the opinions and insights from the panelists. So actually, we are a fintech, but also we are a regtech, as we can call it, and we are representing the enabler which will make the tier 1 and tier 2 banks to take advantage of their data, and to take advantage also of the COVID era that we are all today, since we are all meeting online every day. There are many topics that you mentioned previously about data cleansing, how to prove if there is or not a bias in the data, how the model is accurate or not according to the current credit rating, and the need also for industrialization of the modeling capability. All these together, plus the regulations that all the regulators globally are following, and these are the common regulations like Basel Accord and IFRS 9 or CCL in the US market. All these together create a big sophisticated exercise. And this is why probably it's quite difficult for large tier 1 banks that they are based on technologies that are used for the last decades, actually, not recently. In order to change that, they need to change the whole, let's say, psychological process they are following, first of all. So what I mean by that is that in the market, there is a new Pareto law, the last years especially. We call Pareto law what is happening between the phase of change in a banking environment. Since in order to approach a change, you need first to understand if you can trust the new, let's say, topic that is introduced. So actually, the new Pareto law describes the 80% psychology and 20% technology in the current situation with the big, large tier 1 banks. So we are experts in that, probably Pareto law, because we have achieved to approach quite large banks in 3 different continents to execute projects at the proof of concept and pilot stage with success, and all together to prove that actually all the topics that you were mentioning earlier can happen in reality. So it's a very different approach to say that we can automate something which is not so, let's say, process driven, since credit risk modeling that we're discussing today, it's based on expert judgment. And today with COVID situation, expert judgment and the human expertise is the most important, since the data is not consistent at all. So actually, the way that we have achieved that is by developing a technology and a product which we call Risk Robot. It's quite well known in the market now, and of course in the US market, since we're sponsored also by Microsoft and we're also in their marketplace. And Risk Robot actually has achieved the level of automation and explainability that the regulators require. That's probably the most important message. And this has happened because we just followed a different path from the usual black box engines that are our main, let's say, competitors. Of course, this is not so easy to explain it during a short introduction today, but the most important is about how the banks are taking advantage of that. And the way that we have achieved that is the following, and I would like to share a few use cases. We're approaching the banks as an enabler and not as a disruptor, as we call it. And what we are asking them is to test our solution with their data. And when we say their data, we're talking about models that they develop internally, like probability of default or loss given default models, which are the most difficult models for a bank. And usually this kind of process takes months, usually 12 plus months. Some banks, they say they can do it in 6 months, but probably usually this is about 1 year to just develop one of these models. And we are asking them to exchange tokenized data. And so regarding what Charles was mentioning about homomorphic encryption, since the banks are testing that level of dynamic modeling, currently they can only exchange tokenized data, but this can happen. And what we do is that we input this data in the software and we deliver back to them in a few days, actually, not in a few months, the full model and the full model documentation, which is required actually from the regulatory side. So in our case, we have achieved that automation in the maximum level, at the maximum level, and we have quite significant references from the global industry. Now, what we have seen is that because we're a new player in the market and we're growing quite fast, but we're the only one in this domain, probably, we have seen that the banks are quite a lot as a number. There are more than 20,000 banks from the big banks, and a lot of the new banks that are appearing everywhere, which are either previous fintechs or brand new banks. So these all players, they cannot take advantage of the new technologies because they are not existing in a vast, let's say, quantity. And that's a big issue, again, in the market. So actually, we believe that we are at the turning point now, that the market is trying to urgently understand if there is another alternative way to develop fast the models that they need in order to scale and to provide credit in the market. At the same time, they are urgently looking for any kind of innovation. In our case, we have achieved that level of explainability, auditability in the modeling process. And we are glad that this works actually with all the regulators because we tested that. But the main issue is that the challenges are big and they are still here. And now with a COVID situation, the challenges are going to be increased significantly. So that's the first, let's say, approach.
Okay, Panos, thank you very much. We have a few questions actually now, and unless, let me ask it, do any of the panelists want to respond to Panos, or should we go to the questions? Okay. So the first question is, what is the view of the Fed on regulations between fintechs and banks? I don't know whether any of you can answer this, Mark or Sandip or Charles or Sue, in fact. Do we know what the Fed's view on I think it means regulating the relationship between fintechs and banks, but
if I may, Andrew?
Yeah.
Because in addition to being a board member, I also work with the FinTech Innovation Lab in New York. And one of the clear mandates from all the various regulators is if you partner with anyone, whether it's a FinTech startup or an outsourcing provider, whatever, you are responsible for managing them and overseeing their activities just as if they were your own employees. So you have to make sure that when you start with a partner that they are able to support the types of data requirements that your regulatory bodies in a larger financial institution would require. And as a mentor for the FinTech Innovation Lab, one of the largest things that I do is get people ready for, the data accuracy and the whole quality control process that financial institutions require.
So does that mean that by proxy, fintechs become regulated if they partner with a regulated bank? Is that correct?
I think you could say that very fairly.
De facto, I mean, not directly, but indirectly.
Yeah, they can't ignore regs, right?
I would say it slightly differently. I mean, I would say that a fintech, if it expects to share data with a bank or have a bank share data with it, either because of a direct relationship or because of client requests and things like open banking in Europe, the reality is the bank will hold that fintech to the same standards that it's held to. So the fintech isn't necessarily regulated, but they will have to pass the same standard a regulated entity would if they want that regulated entity to share data with them.
Mm-hmm.
And that's where the whole idea of getting to the point of being able to share data in a way that's privacy preserving would make that less onerous.
Yeah.
Okay, Sandip, did you have something? Yeah.
Yeah, that's right. I mean, we are that case study, right? We are partnering with banks, providing infrastructure and services. So with the way we have conducted is, yeah, both of you are right, Sue and Charles. We have built all our processes and infrastructure completely compliant with all the regulatory laws, basically because that's what banks would like us to do, right? And that's what the business we are in. And starting from SR11 guidance from OCC, Reg B, InfoSec security standards and everything. We are a very compliant infrastructure and platform in that sense. Having said that, from our experience, while we thrive to be compliant with every regulatory laws, we have not been audited once. We do proactive auditing by hiring different vendors and working closely with the bank auditors and regulators, right? But I think even if the letter of law is not there for the fintechs per se, but the spirit is there, and we should all go by the spirit of the law while partnering with the banks, for sure.
Exactly. Mm-hmm.
Okay, thank you. So another question in the Q&A. If anyone else wants to ask a question, can you type it in the Q&A tab at the bottom of the screen? So another question. In fact, there are two questions from Dionysis Palaskas. So if I can combine them into one. So can fintechs and neobanks in the US market succeed by, can they develop credit risk models fast without having a history, without having past transactions? Or do they have to evolve those models over a period of whatever it is, 1, 2, 3 years until they have enough data? So who'd like to answer that question? Panos, go for it.
Yes, hello. So actually, there is a way, because traditionally the way was that any new player would start with a generic scorecard, and they will try to update that at some point. Now, what we suggest is that they can still start with generic scorecard, which they can develop with our software, and they can completely update the model that, because this is again a model, on an ongoing basis as they receive more data from the clients, from the client applications. And at some point, the model will be ready, and we're talking about an ongoing redevelopment, because the redevelopment happens in minutes in our case. And this means that the model will be at a very high standard in order to be used and allowed to avoid the defaults. So actually, the neobanks and fintechs that are providing credit have a disadvantage up to now, or at least they had with the traditional way, which required a lot of effort and coding. But today they have an advantage, and that's probably an easiest way than the open banking situation that is happening in Europe, at least, that the banks are required by law to open, let's say, a gateway for all the players to provide data from all their customers, and so they can increase the competition level. So that's an approach that we can see that it can work in any market, and maybe Sandip has another view as well on that, because he's working with fintechs.
Yeah, so only thing I will say is, I mean, no data, no models. Very simple as that, right? But beyond that, I think there is a way, a couple of ways you can build model faster when you're starting out is you can buy data, right? You can buy data from the bureaus on the product you want to lend on or originate on. And what we call reject inference data in our own circles, you can definitely buy data and do a modeling on that. Alternatively, you can look for other fintechs who might have transactions and models built in a compliant fashion, right? Proper white paper and everything. You can start there. I mean, there are three choices. You can start with an expert scorecard, like Panos said. You can buy the data from the bureaus, or you partner with the fintech. To me, there are three ways you can start using a model framework to start out with.
Mark, do you want to say anything on this? No? Charles?
No,
Sue?
I don't have any.
Yes.
I'll start
I'll
on my
just say,
side.
just a lot of fintechs, although their buzz is that they are using advanced analytics to build models rapidly, a lot of them, their source of advantage isn't as much in the modeling as it is in the marketing and the customer experience. And a lot of them, at least to start, are not using particularly good or sophisticated models. They know that. They know that they'll incur losses for it, but that they factor that into the startup cost. And we'll figure they'll learn as they develop, as they get the data. But a lot of them start with, not models that are in any way, any better than anyone else's, and focus on other aspects of the experience, customer experience, and customer marketing and selection, as opposed to customer credit analysis.
Let me just add to Mark's point. I think the risk appetite for a fintech is higher than it is for a traditional financial institution. That's just a fact. But also they are more nimble, and they are able to take in information about where they're seeing losses, et cetera, in addition to the acquired data. So they're able to move and change their models more rapidly. That's my understanding anyway. Mm-hmm.
Okay, excellent. Any other comments? I think Charles was a no, right?
That is correct.
Okay. Does anyone want to talk about any other aspects? I mean, I think we've had some very interesting points raised. The only other answer in the feed is about the recording. Asking if there is a if the roundtable has been recorded, where can that be listened to afterwards? So I don't know whether the organizers can provide that link to the people who've joined in. So any closing remarks? Would anyone like, because the takeaway for me is that the technology evolution is exciting. It's probably easier for as we said, for the nimbler, smaller banks, fintechs to take advantage of it, but the very large banks have the resources and have the innovation groups and teams to do this. So there seems to be a lot of positive messages there, and the question is, how quickly can this industrial revolution of credit risk modeling happen? So I don't know whether anyone would like to take a punt on on answering that question as a kind of closer.
I'll throw out a few thoughts, and that is, I think it's a great time to be in this type of a field, data, credit. I mean, it's the likes of which are, second to none. And so I do think the people that can add value in making the world a better place, less biased, more nimble, et cetera, will have a wonderful time.
Excellent. That's exciting. And who else would like to, anyone else like to be positive? Anyone else like to add some words of caution? Sandip, go for it.
I think the idea of digital credit risk modeling is exciting, relevant, and has a lot of staying power specifically. But the only cautionary thing, the broader, not specific to digitized credit risk modeling, is there is a step change. We're waiting on all the regulators of US banking community to give a clear signal, an updated signal to the whole of banking FIs and even some of the non-bank FIs who are waiting on them to unleash the broader era of modeling innovation, data innovations. I think that will be a crucial milestone in the fintech and finance services journey from here on.
But is it not the case? I mean, Sue suggested that it's actually the banks, it's the industry that should be proposing things to the regulator, not the other way around. And traditionally, the regulator has been or the regulators, I don't know about the US, but certainly in Europe, Asia, they've been more reactive and have, if in many aspects, obviously doing a very good job, but they have tended to lag the market. So, you know, how can the banks push harder, Sue?
I mean, they're providing there's a lot of RFIs and RFPs going on from CFPBs and FDICs of the world now. Okay. I think they're collecting input as we speak. In fact, we are submitting a write-up to the regulatory bodies. I think the ball is moving in the right direction. Now, but at the end of the day, the outcome, the product will come from the regulatory bodies. Yes, banks can be proactive, but the letter of the law has to come from the other side. I think sure. That's the only thing I will throw out. Otherwise, it's exciting. Exciting times and very optimistic in that sense.
You know, I would just point out that, you know, the US government, okay, pick your agency, is not known for having the best technology or, you know, the smart, bright, innovative people, which is why I'm suggesting that it's the financial institutions, whether they're a fintech, a mid-sized bank, whatever, that really need to take the lead on recommending the way forward. Ultimately, yes, the regulators have to approve it and it becomes the letter of the law that we all have to follow. I'm just saying, you know, control your destiny, because if you don't, it could be very, very ugly. And, you know, I do think that there is a need for, you know, some pretty significant change here. So it's a great opportunity, as I mentioned earlier.
Great.
Remember that I mentioned earlier that the, you know, half a dozen of the largest lending startups have put a stake in the ground and reach out to the CFPB because the chairman's about to be named. And he has a reputation for really wanting to understand black box models. So that's an example of they're trying to control their destiny and say, you know, we want to collaborate and, you know, move the world forward, right?
Yeah. Okay. So any other Panos, Marc, any other remarks you'd like to close the session?
Yeah, so actually it was a pleasure listening that there is a big change currently in the market. Probably COVID accelerated the process. That's a signal. But either way, the banks had to take a decision to move forward. And I still think that the effort that we did as a company, as a RegTech, to develop a product that is following the regulators, it's at least in the right direction, because we have proven that with the current projects. There is a big need for the banks to provide credit actually in the market currently. And that's another topic that we have to expect in the coming months, not so far in the future. And probably there is again a big opportunity. And probably the regulators will take advantage of that process, because there are currently a lot of changes, even at the regulatory point. They are trying to create innovation hubs globally in order to coordinate. So there is an ongoing process, and we are living on a wave that is growing. And probably we just need to ride the wave.
Yeah.
Okay, well, thank you, everyone. Thank you again to Francis and DJ for organizing this. Thank you to the panelists, Sue, Sandip, Marc, Charles in his absence, Panos. I think it's been a very interesting discussion, and actually it's kind of evolved and flowed in a way that quite different to the other roundtables we've had. So thanks for your participation, everyone. And with that, I will close the session.